As this stroll down memory lane is making us nervous. We're worried about another wave of possible bank failures. We don't want any stock crashes. We don't want any bailouts. We want to see the market settle on its own. We're going to bring in tonight's panel, Tom Belesis of John Thomas Financial, Tobin Smith. He is one of the smartest traders around. Of course, David Asman is still with us in Australia. You know, Tom, let me take it to you. What do you think of what's going on in Europe? Are we seeing a bigger crisis going on in Europe about to blow?
I don't. You know, the issue is here is these rumors become self-fulfilling prophecies because they spread from bank to bank. You see the Asian markets now, and certain Asian banks are cutting off credit to the French banks. So what happens now? People get uncomfortable, so they start checking out what other banks may have these bad assets or these that may have bad liquidity problems, and they stop doing business. And that's what shuts down business, is confidence. And that's what happened here in our country in 2008. People lost confidence. Why? Because banks will default, and there was no liquidity in the system. So the rumors spill over. So I don't think we'll have an issue like this now, because I think the governments and the Federal Reserve are better prepared now than they were back in 2008.
Tobin, is Europe basically stage manning the way they've been responding to their banking crisis? Is it making the banking sector there more liquid or more insolvent?
Well, Liz, remember that the banking sector is a code word in Europe for Germany, because the equity, most of the equity is in Germany. Certainly the firepower in the economy is. The problem, as we all know now, is that we created a euro, but we didn't create a common financial system. So this is the fallout of a really poor plan that was instituted really, 20 years ago and came into fruition 10 years ago. What we are going to see, in my opinion, is TARP 2. We're going to see it at about a $2 trillion level.
In Europe.
All the pieces of that puzzle have been set.
All right. David, what do you think of Euro TARP?
I think it's a disaster. The thing to keep in mind about Europe, of course, is that it is so much more of a government-oriented economy. We're kind of getting into that in the United States, and TARP is our biggest entry into what not quite yet, but the fact is that they are accustomed to doing this, even though it hasn't worked in the past. I think they are about to see what we saw with our stimulus program. They're about to see one of the biggest failures of government intervention they've ever seen before.
Yeah, but some people quickly, David, would say, hey, you know what, the government had to step in. If it didn't step in, we would have blown a bigger hole in the U.S. economy.
As Jim and I were talking, they may forestall what is going to happen, but by forestalling it, they may actually make it worse.
All right, we're going to leave it there. We want to know what you think. There will be another bailout. Is that statement a buy, sell, or hold? Text us at 369-249 on deck. Speaking of 2008, Europe smacks the shorts just like we did 3 years ago. It's get shorty time. We're going to hear from a famous financial advisor, Ed Bukowski. He sees something flashy and short in all the big moves. Do not be nervous like the guys on Wall Street, though. Just stick around. Scoreboard goes global with David Asman from Australia. Stick with us. All right, we've got breaking news on gold. Look at this. Gold. Look at the action in gold. It has been hot lately. It did touch above the 1800 mark, and it broke down now today in trading. But look at this. It is now moving up by almost half a percentage point. It's up about $7. We're going to possibly trend back up toward the 1800. Who would have thought $1,800 an ounce? You know what? We thought 2,000 by the end of the year, but watch gold. Now, we're going to get you up to speed on the Asian markets as we head into the bottom of the hour. All of the Asian markets are back tipping into the green just fractionally. The Nikkei is moving up. Kospi is up about a percentage point. The Hang Seng almost 2%. The All Ords also 1.5 percentage point. Let's go over to the U.S. stock futures, still in the red, marginally so, half a percentage point on the Dow, down 58 points. S&P 500 down about 2/3 of a percentage point. The Nasdaq also down 12 points. So is it time to bet against Asia? As David is suggesting, we're going to bring in the most valuable panel of all. Democratic strategist Chris Hahn joins the fun. All the rest of the gang is here. Chris, what do you think? Time to bet against Asia?
You know, I wouldn't bet against them just yet. Like they said, they still have a long way to go and a lot of growth to happen there. What's going to happen, is they're going to continue to grow because they've got room to grow. And the United States is still going to buy their products because they're still going to be cheap for the next 10 years at least, because their economy's not going to create a middle class that's going to wipe out their cheap labor force for at least.
Yeah, that's a good point, Tobin, because what Chris is essentially saying is China doesn't have the consumers don't have purchasing power yet. Inflation is rampant. And Tobin, you know what was really annoying this week was China saying we have a spending addiction and basically criticizing us for being dropped to AA+. Well, guess what? China is AA negative, and it has a worse debt to GDP ratio than insolvent Portugal. What do you make of that?
Look, there's two things you have to understand about China, I believe. Number one, the Australian minister had it absolutely right. We're talking about somewhere near 30 to 40 million new people in the middle class every year. The middle class right now is about $4,500 American dollars for a family. That right now is 250 million people. In other words, the larger middle class than we have in the United States by far.
Yeah, okay. We got to take it, Tommy.
That's what's driving it.
I mean,
that's
Liz,
what's driving the economy.
Okay,
I share a lot of the same views you do about China, but, you know, the bottom line is they have a booming economy, and you see no sign of a slowdown. I mean, you see Australia and China have a great partnership. Australia shares a lot of their resources and equipment to China, so right now Australia should continue to do as much business before they slow down.
Yeah, but, you know, David, Jimmy Chanos, famous short seller on Wall Street, you know, I have been in contact with him through the years, and he says, you know what, watch out for China. He is not believing the China growth story. He thinks it's a big paper tiger. And again, I got to tell you something. You know, even though Tobin likes to go the na-na-na-na route, whatever that was, listen, China has a lot of debt in the system, a ton of debt in the system. Fitch Ratings says their debt to GDP is actually 185%.
Wow.
What do you make of that?
But they have a ton of cash,
no, not
too.
you, Tobin. We already heard from you. Go ahead, David.
Okay. All right. Well, the point is that 65% of the GDP of China depends on exports. 65%, only 35% of the GDP is domestic. It's exactly the reverse of the United States, which has about 70% consumption as measured by the GDP. So until that changes, yes, there is tremendous potential. Yes, you certainly cannot ignore 300 million middle-class Chinese people who eventually are going to be importing things. But for the moment, they are dependent on their exports. And if their export markets begin to dry up or significantly slow down, as may happen if the United States and Europe go into another recession, even if it's a mild recession, that's going to hurt China. There's just no way you can get around that when they're exporting 65% of their economy.
That's right. A lot of borrowing money and a lot of paper creation to support that export base. David, it's always good to hear from you, sir, and the rest of the gang. You're always brilliant, including you, Tobin. I do love you. Now, next on deck, Scoreboard, even though this is like the kitchen table at Thanksgiving, isn't it? And Tobin's at the children's table. I just banish him. Anyway. Welcome back. A volatile ride for the markets this week, leaving many investors wondering, you know what, where do you put your money? Should we be turning to corporate insiders and what they're doing? GM CEO Dan Akerson buying 10,000 shares of his company's stock earlier this week. He's not alone. He's not the only CEO investing in his company. We're going to show you a list. Corporate insiders are buying shares in their own companies, and it's happening at the highest rate since 2009. Time now for tonight's power rankings of insiders buying their own company's stock. Let's take a look here. We're going to tell you a lot of information here. This is very, very interesting stuff. Chiquita. We also have Six Flags buying. We are seeing Floor Corporation. Tommy B., what do you make of that? Is this a good sign?
It's a very bullish sign. We need more of that, actually. I mean, when people, CEOs, to buy their own company stock, it shows that over the next few quarters that they foresee greater growth versus worse growth. So it's a very great sign. All
right, let's show the list now of the 5 companies that we have that are buying, where CEOs are just purchasing their shares. Gang, can you punch up the list? Number 5. What do we got? Kinder Morgan. You got the other, there they are. You're going to see Dell coming up. You're going to see Kinder Morgan. Now you got Chiquita. Look at that. Chiquita is also in the top ranking. And next up, we're going to see Fifth Street. This is basically a ranking on the dollar amount of the purchases of insiders buying stock. Morgan Stanley's in there. And guess who's number 1? Six Flags. Tommy B., what do you make of that, Six Flags?
I think they foresee their business is growing over the next few quarters. So
yeah, but Tommy, isn't this a bad sign, too? You're seeing this at Home Depot, and you're seeing it at Lowe's. In other words, what's happening is those companies' earnings have not been doing so great, and the stocks have been getting a little bit slammed. What do you make of that trend? How should investors really look at this trend?
I think they should really take the percentage, the average percentage return that when insiders buy stock, how they end up being after 6 months when they do. And that could give a good sign for investors to pick the companies that are buying stock back in the market as a tail to buy those particular stocks in the market.
So you're talking about the companies that have relaunched or have launched stock repurchase programs,
correct.
Right? So you're talking about Walmart, General Electric and General Dynamics. I mean, I think GE, just relaunched a program that they had stalled out, I think, a couple of years ago. Would you buy stock in GE right now? Would you buy stock in any company that's repurchasing shares?
I feel very confident in buying those companies because the CEOs are stepping up to the plate and using that cash they have on the books to put back in the market. So it's always a bullish sign.
All right, good for you, Tommy B. Always good to be with you. Thank you so
very
much.
much,
Next
Liz.
on deck, gold bugs.